if we think we're not going back to the world of zero interest rates, quantitative easing, sustainably, which we think there's an argument to suggest that we're not going back to that type of environment, and that there are again there are a number of positive longer term bullish narratives in the U.S. economy and the global economy. Don't get me wrong. Again, we follow the business cycle. We were really bullish in 2021. In fact, we had the highest target on Wall Street. We're bearish or moving towards a bearish view ultimately now because we follow the cycle. Which means that at some point the cycle will turn back up, probably some point in the early, maybe middle of 2024. From automation to onshoring, there's a lot of long-term bullish narratives for the U.S. economy and the U.S. stock market. It's not going to look like it did the last 13, 14 years, where we had really good returns in a real narrow subset of large cap growth stocks that lifted the index and lifted U.S. relative performance compared to the rest of the world. When you look at equities around the world, they tend to be far more cyclical than U.S. equity markets, especially today. So I think, if the U.S. markets have strongly outperformed the rest of the world really since 2011, that we're probably not going to be swinging back to the opposite extreme. We're going to be somewhere more in the middle. And so I think, inflation and interest rates are going to, over the next 5 years after this downturn, normalize at a higher level than where we were the prior decade plus, which suggests that you're not going to see as much strong growth leadership, and you'll see some better cyclical and value leadership. Again, I don't think we'll be at the tails of either one of those. I think a good balanced portfolio makes a lot of sense, and that didn't make a lot of sense, from 2011 to 2021. You wanted to be heavily tilted towards growth, and prior to the global financial crisis, you wanted to be pretty heavily tilted towards value and cyclicals. So I think we're going to see more volatility in the macro environment and therefore in the market environment. And so taking extreme bets on one side of a spectrum, whether it's large versus small cap or growth versus value or US versus the rest of the world, probably doesn't make a lot of sense. Or being barbelled probably doesn't make a lot of sense over the long term. Being more thoughtful and looking for companies that are, really idiosyncratic winners that don't depend on the macro as much, I think could kind of be a better way to position. But I think the easy days are behind us.